This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Green shoots. The head of the European Central Bank is more upbeat on the Eurozone economy than he's been in quite a while and tells investors something they've been eager to hear.
Downbeat forecast, the world's second largest economy, cut its growth target to the lowest level in more than 15 years. And now the government has a plan to increase spending.
Stress test banks once again under the microscope to see if they can withstand a severe market shock. We'll tell you how they fared. All that and more tonight on Nightly Business Report for Thursday, March 5th.
Good evening, everyone, and welcome. Europe, it's been one of the global economy's weak spots, and today the head of the European Central Bank took the next step in his battle against that sluggishness, rising unemployment, and the risk of deflation in the Eurozone. Mario Draghi signaled confidence in Europe, something investors haven't heard from him in quite a while, and he said his massive bond buying program will begin in just a few days. Today, reaction was felt in the currency market as the euro fell below the 110 level for the first time since 2003. Annette Weisbach now on details on Draghi's plan from the European Central Bank's meeting in Cyprus.
Finally, we actually know when the ECB is going to start its quantitative easing program. It will be next Monday. And we also know now that the ECB is also going to buy sovereign debt with negative yield. Apart from that, Mario Draghi left the doors open to perhaps even extending the QE program beyond its currently planned date of 2016, or even scrap it before. It will all depend on inflation development here in the Eurozone. But one can say that Mario Draghi is very upbeat about the economic development here in Europe, now predicting that GDP growth on average will reach almost 2% by next year, and also inflation expectations will probably be back close to its target by 2017. So bottom line, the ECB is actually kind of declaring victory without even having started their big QE program here in the Eurozone. For Nightly Business Report, Annette Weisbach in Cyprus.
So did ECB President Mario Draghi finally give the European economy the juice it needs? Steve Leisman takes a look at whether Draghi got it right and the risks that still remain.
The economy has been so tough in Europe that the only bulls you could find are like these, the ones in the running of the bulls in Pamplona, Spain. But now there are some real economic bulls, people not running from a ton of angry beef, but who are actually optimistic on the European economy.
We think QE will work. It'll help through the exchange rate. As that exchange rate moves lower, it makes a lot of Europe more competitive. So I think there's some better news ahead for the continent in general.
European Central Bank President Mario Draghi announced today that Europe would launch its much-anticipated quantitative easing program on March 9th, buying 60 billion euros of public and private bonds a month from now until at least September 2016. Draghi insists this will turn around the sluggish European economy, and the ECB is now predicting 1.5% growth this year, up from 1% in the prior forecast. That would be the best year of European growth since 2011. The 2016 outlook was also raised.
In an environment of improving business and consumer sentiment, the transmission of our measures to the real economy will strengthen, contributing to a further improvement in the outlook for economic growth and a reduction in economic slack.
This is not the first run of the bulls in Europe. Other ECB programs before have prompted similar outbreaks of optimism, only to be trampled by the reality of anemic growth, rising unemployment, and economic chaos in peripheral countries like Greece. The troubles in Greece and the possibility of an exit from the Eurozone remain a major question mark, as does the concern over whether low interest rates from the ECB's program can really help cure what ails Europe. Draghi insisted today that the ECB's bond purchases were only part of the solution.
It is crucial that structural reforms be implemented swiftly, credibly, and effectively, as this will not only increase the future sustainable growth of the euro area, but also raise expectations of higher incomes and encourage firms to increase investments today.
But European stocks have been on a bull run since January, up 14% compared with just 2% for the S&P 500 in the U.S. Whether there's more room to run may depend on if the ECB's program can bring wealth not just to the financial sector, but also to the real economy. For Nightly Business Report, I'm Steve Leisman.
And joining us now to talk more about the ECB meeting and the Eurozone is Samir Samana. He's global strategist with Wells Fargo Investment Institute. Samir, welcome. Nice to have you here.
Thanks for having me.
I guess it's a little too early to sound the all clear, but this is an improvement in Europe overall that a lot of people thought would take a little bit longer to materialize.
Absolutely. You know, we all know the perils of declaring mission accomplished a little too soon, but, you know, for the first time in a while, what we've seen is expectations have been really low and they've been exceeded. And so you had space for the ECB to surprise, which they have, and you've seen some space for economic data to surprise, which it has. You know, you're seeing a lot of the positives that you saw in the U.S., if we can maybe use that as a blueprint. Unemployment's starting to come down, retail sales are starting to go up, business and consumer confidence are starting to improve, and most importantly in the euro area, inflation expectations are going up.
So do they need to do quantitative easing?
You know, they do, you know, because one of the things that Steve mentioned is how there have been some, you know, stops and starts over the last few years. And so what you need is persistence. And even the Fed realized that here with the last round of QE is that they needed to have it be open-ended in order to make sure that people weren't running ahead of them towards some time-dependent date in the future. And so, you know, Draghi, having learned from that, has said time and again, you know, we're going to do this out through, you know, September 2016, but we will make it go beyond that if necessary.
You know, Steve Leisman, in his report just a few moments ago, mentioned the fact that Europe has been outperforming in terms of its stock market's performance compared to the U.S. and some other areas as well. But are earnings strong enough to continue to propel that forward?
Last year was a bit of a disappointment, and I think part of that has to do with, you know, obviously the dollar falling dollar rising as fast as it did, some of the foreign currencies falling as fast as they did, which reduced the amount of earnings in dollars, which is really what, you know, U.S. investors care most about. Now I think the pace of currency appreciation probably slows, I think because a lot of the quantitative easing announcements are out of the way, and so the companies get to really get down to the business of, you know, trying to sell more stuff and get better margins. And so, yeah, we think this year we finally start to see that positive earnings growth reassert itself.
So, Samir, if the idea of quantitative easing, because so far it's really only been an idea or a promise or the threat of, is what it took to get the European economy back on its wheels, why didn't they do it sooner? And I don't mean to be too critical of the political process over there, because Lord knows it would be sort of pot calling the kettle black from Americans criticizing European politics.
Sure. So, you know, I think some of it has to do with, call it just tradition. You know, there's been a greater fear on the European side about inflation. I mean, they've dealt with their own bouts of hyperinflation. That's obviously left a mark because of how painful it can be to stamp out inflation. I mean, the U.S. went through something very similar in the 70s and 80s. You know, obviously we're a little bit further along from that, so maybe the memories aren't as painful. So I think that played into it. The Germans obviously, you know, want to make sure that, you know, the currency doesn't weaken too much. Obviously, that's something that's in their best interest to have a currency that's somewhat strong. So I think for all those different reasons, the political problems that you mentioned, I think they were a little bit slow to the party. Also, I think they wanted to see how it would work out in the U.S., and it's had some great results.
Where would you put money to work in Europe? You like certain sectors or countries?
We like countries that will benefit from the resurgence in overall economic activity, but maybe aren't the high flyers that we've seen, you know, call it over the past year. So Germany, you know, kind of that steady Eddie, you know, a very industrialized nation, has a lot of exports of machinery around the world, benefiting very greatly from the lower euro. The UK, which has one of the economies that, you know, if you talk about outside the US, where might there be real areas of strength? The UK's done very well. And then Switzerland. I know there's been a lot of talk about how they let the Swiss franc come unpegged, but, you know, once again, a lot of large consumer staples and healthcare companies, you know, based in Switzerland that are doing very well in the current economy.
Samir, thank you so much. Samir Samana with Wells Fargo Investment Institute. Ty?
To China now, where the government has lowered the country's growth forecast for 2015. China now says it expects the economy to grow about 7% this year, down from last year's 7.5%. Lowest economic growth target in 15 years. Susan Lee now with more from Hong Kong.
This is the new normal in China. We had the Chinese Premier Li Keqiang at the National People's Congress, the NPC, today, as expected by the market, saying that China's GDP and the target will be set at 7%. But then he added some vagueness and some uncertainty in the markets when he added the word around, because it has a lot of people thinking, okay, are we going to be guided down even further? And could that expansionary rate have a 6% handle in 2015 instead? Also, some surprises when it comes to spending. China's going to increase their spending this year, 10% more than last year, to $2.74 trillion. And they're going to spend on railways, they're going to spend on water projects, and they're going to spend on agriculture. But they don't want this to be misconstrued as a big stimulus package. But it does increase their budget deficit to 2.3%, which is the widest for China since 2009, when they had to guide the economy through the global financial crisis. Also, I guess what's going to catch the White House's eye is the increase when it comes to military spending, up from 10% in 2015. And really, that's been the trend for the last few years, and China is the second largest spender when it comes to defense. For Nightly Business Reports, I'm Susan Lee in Hong Kong.
Stocks edged higher, breaking 2 days of losses as investors focused on that upbeat news out of Europe and in anticipation of tomorrow's jobs report. The Dow Jones Industrial Average rose 38 points to close at 18,135. The Nasdaq 15 points higher, and the S&P 500 was up just 2 points.
In deal news, Abbvie will buy Pharmacyclics for about $21 billion. The deal expands Abbvie's reach into oncology and gives it access to what's expected to be a blockbuster blood cancer therapy drug. For Abbvie, the deal lessens its dependence on an arthritis drug, Humira. Shares of Pharmacyclics popped 10%, while shares of Abbvie fell more than 5.5%.
And now to the U.S. economy, which saw factory orders fall for the 6th straight month. The Commerce Department said new orders for manufactured goods slid 0.2% below expectations, and it follows a revised 3.5% drop in December. Manufacturing has been hurt by softening demand in Europe and Asia.
The major economic data point of the week is due out tomorrow morning when the Labor Department releases the February employment report. According to Dow Jones, non-farm payrolls expected to increase 240,000. That's down a little bit from the previous month. Economists are looking for the unemployment rate to fall slightly to 5.6%. Average hourly earnings expected to bump up 0.2%. And there are a few things both Wall Street and Main Street will be watching for, and Hampton Pearson knows what they are.
Bitter winter weather in much of the country and job losses in the energy sector due to declining oil prices are key reasons why leading economists expect a job growth slowdown in February. Nearly 40,000 jobs have been lost in the energy sector in the first 2 months of 2015, according to a leading job placement firm.
Right now, we're seeing, in the midst of this expansion, one sector that really is going through the change, and that's energy. 38% of all cuts right now for the first 2 months of the year have come from that sector.
Today, the Labor Department tells us first-time unemployment claims topped 320,000 last week, pushing the 4-week moving average back above 300,000, the highest since mid-January. Earlier in the week, a closely watched forecast for private sector job growth showed a gain of just 212,000 jobs, down from 250,000 last month.
We have to finally get to see the promised land, which is spring, I think, before we finally start to see the economy revert to the growth trajectory that we had for much of 2014, and I think will, finally give us growth over 3% in 2015.
When the Federal Reserve meets in 2 weeks, sure signs of spring for monetary policymakers would be wage growth and a rebound in consumer spending. But the recent economic data shows there's still work to do in both categories. For Nightly Business Report, I'm Hampton Pearson in Washington.
And coming up, the country's biggest banks undergo stress tests to see if they could withstand a severe recession. The results next. The nation's 31 biggest banks passed a test of how they would fare in an economic crisis. Those tests are conducted by the Federal Reserve, and next week we'll be told whether or not they can go ahead with planned dividends. Kayla Tausche is with us and has more on those results of the tests. I think it was encouraging that all of the banks passed, but they all kind of got different grades.
Yes, encouraging, but that's of course going to lead critics to say, is the test too predictable? Is it too easy for the banks to figure out exactly what they need to do with their balance sheet? But for now, Sue, it is good news. All 31 banks, representing 80% of global banking assets, passing this test, which is quite a vote of confidence in the length that they have, the measures that they've taken to actually build up those capital levels after the crisis. They've come a long way.
This is like the Common Core for bankers, I suppose. Dividends, a key issue, most especially for Citibank or Citi. Does this make this more likely that they'll be able to pay them?
This is only part one of the test, and while it is a vote of confidence, it's pretty much just that, because they all cleared the Fed's capital bar, but that is not including the calculus needed for buybacks, for dividends, and of course that was the first thing that banks had to scrap when they realized that they needed that money, that cash, in the financial crisis. So now the Fed really wants them to take a hard look at how they're planning to pay out those dividends and those buybacks. They thought that Citigroup last year had enough capital on hand. It wasn't a quantitative issue. It was what they called a qualitative issue. They didn't think that their risk controls were strong enough. The bank has spent the entire last year to fix that, but of course it's only up to the Federal Reserve at this point.
Are there some banks out there that are viewed as, of course, none of us know because we're not doing the tests, but are there some that are viewed as more vulnerable or perhaps less prepared and might not get the okay to issue the dividends and do the buybacks?
It's an interesting question. Deutsche Bank is undergoing the stress test and the CCAR, which is the capital planning process, for the first time. So when a bank goes through it for the first time, of course, it's an opaque process. They unfortunately usually learn things the hard way. Santander and Ally Financial also have a lot of exposure to this new boom in subprime auto lending. It's unclear what that will be treated like under these levels. And also you have a lot of the big banks, JP Morgan, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley, that have a lot of exposure to capital markets. There was a new test that put a new strain on the capital markets that brought some of those capital levels down. So it could see something where the big banks wanted to give back more money to shareholders, and they're going to have to temper their expectations a little bit. They tweak the
test every year?
They tweak it every single year. They don't want it to be predictable. They want banks to, you know, they want them to have a safe enough balance sheet that no matter what happens, their assets will be safe.
All right, Kayla, thank you so much. Kayla Tausche.
Costco announces a surge in profits in its latest quarterly results, and that is where we begin tonight's market focus. The wholesale giant's numbers were lifted by a tax benefit related to a special dividend because of lower fuel prices. The revenue was slightly below estimates, but same-store sales rose more than expected. The stock was almost 3% higher today. It finished at $151.17. Kroger also announcing a big pop in earnings. The grocery store chain's quarterlies beat on both the top and bottom lines. It was also helped by lower fuel costs. Full-year outlook also topping views. Shares up almost 7% to $74.31. And comments from Boeing's chief financial officer helped lift the Dow component today. He told investors that cash flow levels will rise in coming years, but investors should expect the gains in the 2015 to come in toward the end of the year, not sooner. The stock rose slightly to close at $154.47.
And Simon Property Group is mulling a bid for rival mall owner Macerich. That's according to a report in the Wall Street Journal. The mall owner hasn't made any formal offers yet, although it did reveal a stake of about 3.5% in the company last year. Shares of Simon were down just slightly to $187.13. Macerich popped about 5% to $88.07. Hopefully I pronounced that correctly. And shares of Kythera Biopharmaceuticals surged today after reassuring news from regulators. The Food and Drug Administration has backed its injection for double chin reduction, saying the benefits of the treatment outweigh the risks. Shares soared some 25% to $50. And after the bell, Gap reporting a surprise drop in February same-store sales. The retailer's namesake store and its Banana Republic divisions both saw declines. Shares were volatile after hours. At one point, they were down more than 2%. But before the close, the stock was down about 1.5% to $41.43.
Still ahead, the retirement mistake you don't want to make when planning for your golden years. If you're thinking of retiring young, you're not alone. New research from Boston College's Center for Retirement Research says that the average age now for women retiring is 62, and for men it's 64. But is retiring too young harmful to your financial health? Let's ask Shannon UC, president and co-founder of Beacon Point Advisors. Shannon, welcome. Good to have you with us. I was reading some numbers the other day that a couple age 65 today has a better than 2 out of 5 chances that one or both will reach age 95. So your money's got to last 30 years in retirement.
That's absolutely true. So we tell our clients that, gosh, if you want to retire at 62, you better have the nest egg in order to do so. And we want to know with 80% accuracy that their portfolio is going to last till 95.
So if they do indeed put off retiring, what kind of percentage benefit can they see? How much better is it for them to quantify the advantages of working a little bit longer?
Absolutely. You know, if clients, we've got a client who wanted to retire at age 66. We told him, you know what, it's probably better off if you retire at 70. He's going to receive 25% more in Social Security benefits. And you think about it, during that 4-year period, he's also able to contribute to his 401k plan as well, and tax-deferred assets are able to grow in a tax-free way.
And maybe biggest of all, Shannon, is that during those 4 years, he's not relying on his portfolio. He's leaving it alone. He's actually building it, so he's not drawing money out.
Absolutely. So you know what, if we have a client that wants to retire at 62, 63, 64, wants to retire a little bit early, they've got 2 options. They can either retire early and really save their portfolio and spend quite a bit less. So I would argue saving 30% over the next 30 years is better than taking 2 years and working longer.
Also, you know, if you stay employed and your company offers health benefits, then you don't have to deal with the fact that a lot of times when you retire, you have vastly diminished health benefits, if any at all, for some companies.
Yeah, there's no question. That is the single largest expense in retirement that folks often don't take into consideration. So we want to make sure that we model for that and plan for that for our clients.
What, Shannon, is your, you know, the old rule of thumb is that once someone does retire, for their portfolio, for them not to outlive their portfolio, that they should aim to take out roughly 4% a year. Are you down with that, or is that just, you know, a rule of thumb?
We agree with that rule of thumb, but obviously it depends on what, you know, it's a little bit cliche, but what their happily ever after goals are. Do they want to play for their grandchildren's education? Do they want to take a trip around the world? So all those we need to take into consideration as we're planning that spending rate.
How do you feel about the overall savings rate for most Americans today? I think that's one of the most worrisome things as we see some of these figures and people are so underinvested and they have not saved hardly anything towards retirement.
I think that's the biggest concern. So we've got to make sure that as we're in our 20s and our 30s and our 40s that we're really starting to save early, because the compounding of wealth in your 20s and 30s allows you to save quite a bit less in your 40s and 50s and 60s.
Shannon, what Sue and I are most concerned about is whether we can retire in Newport Beach. Thank
Yes,
you so much for joining
Absolutely.
us. Thank you so much for joining us tonight. Shannon
Thanks for having
UC
me.
with Beacon Point Advisors.
It looks so pretty out there, and I'm sure it is. Finally tonight, Fortune is out with its annual list of the best companies to work for, and for the first time, the ranking also includes the best companies for women to work at. The overall list is based on factors like trust and sense of mission, and here are the top 3 firms. Acuity, a private insurer, landed the 3rd spot. It offers perks like no limit on tuition reimbursement. At number 2, the Boston Consulting Group. And for the 6th year in a row, Google has clinched first place. The tech giant is famous for its benefits like free cafeteria and complimentary laundry service.
Techies do laundry. Wow.
No, Google does their laundry.
Google does their laundry.
All right, that does it for Nightly Business Report for tonight. I'm Sue Herrera. We want to remind you this is the time of year your public television station seeks your support. Take it over.
All right, Tyler Mathis here. On behalf of your public TV station, thanks for your support. And we'll see you back here, Jobs Day, tomorrow.